The most dangerous lie in modern finance is that stability is the default state of the market. It isn't. Stability is an anomaly. Chaos is the historical norm. Right now, the majority of investors are sleepwalking off a cliff because they are staring at the price of silver and seeing nothing. They see a flat line. They see boredom. But if you look beneath the surface, you don't see stagnation. You see a tectonic plate that has been pushed against a fault line for years. The pressure isn't gone just because the ground hasn't shaken yet. In fact, the longer the quiet lasts, the more violent the eventual snap will be. This is not a prediction about tomorrow. It is a mathematical certainty about the structure of the current system. The question everyone keeps asking is whether they have missed the boat. They see a small rally and panic that the opportunity is gone. This is a fundamental misunderstanding of scale. We are not looking at a standard market cycle where assets move up and down by small percentages. We are looking at a structural repricing of real money against paper promises. When you look at the valuation of silver compared to gold, the disparity is so wide it looks like a glitch in the matrix. Historically, when a gap this large closes, it doesn't happen politely. It happens with the velocity of a rubber band snapping back. We are currently sitting in a window of time where silver is priced as if the world is perfect, while the geopolitical and economic reality suggest the world is fracturing. To understand why this move is inevitable, you have to stop looking at the stock market. The stock market is a distraction. The real story, the scary story, is happening in the bond market. Government debt is the foundation of the entire global financial architecture, and that foundation is rotting. Governments are drowning in obligations. They cannot pay with real value, so they must pay them with printed currency. This is the quiet risk that nobody discusses at dinner parties. When the bond market begins to slide, central banks have only one move left. They must print money to buy their own debt. They call it liquidity support to make it sound technical and safe. It is neither. It is the debasement of currency to keep a dying system on life support. This is where the psychology of the investor is tested. Most people are terrified that a stock market crash will drag precious metals down with it. They remember the liquidity crunches of the past where everything was sold to raise cash. And yes, in the initial moments of a panic, everything falls. But you must look at what happens when the smoke clears. When the system breaks, capital doesn't disappear, it flees. It runs from the burning building of paper assets and looks for the exit door. In the sovereign debt crisis, that exit door is hard assets. Silver is not just a commodity in this scenario. It is the only lifeboat that is still affordable to the average person. This brings us to the concept of the single kilo. Why does this specific weight matter? Because it represents a shift in mindset from collecting to insuring. Most people treat silver like a hobby, buying an ounce here and there. But when you hold a kilo, you are holding a substantial store of energy that has been compressed by decades of price suppression. It is an asymmetric bet. The downside is that the price stays boring for a little longer. The upside is a life-changing repricing of your purchasing power. It is the difference between hoping for a small gain and preparing for a paradigm shift. Consider the supply chain. We are living in a world of deficits. Silver is being consumed by industry, by green energy, by military technology, faster than it can be pulled out of the ground. For years, the price ignored this reality. But physics always wins in the end. When the above-ground stockpiles and major vaults begin to bleed dry, the paper price, which is manipulated by futures contracts, loses its grip on the physical reality. We are seeing premiums stay high even when spot prices dip. This is the market telling you that the physical metal is disappearing into strong hands. These are not tourists. These are entities that do not plan to sell. The timeline for this is the next 6 months. This is the window where the illusion of a soft landing will likely collide with the reality of interest payment mathematics. If you're waiting for the news to tell you to buy, you are already the liquidity for someone else's exit. By the time the headline reads silver skyrockets, the physical metal will be gone, or the premiums will be so high that the move is mathematically over for you. Early feels uncomfortable. It feels lonely. You look around and see everyone else chasing tech stocks and meme coins. But remember, the crowd is always right in the middle of the trend and always wrong at the turns. Let's analyze the mechanism of the breakout. It usually happens in 3 waves. The first wave is disbelief. The price moves and everyone calls it a fake out. The second wave is frustration. People wait for a pullback to buy in, but the pullback never comes. The third wave is the mania. The public realizes what's happening and chases the price vertically. We are currently transitioning from the quiet accumulation phase into the disbelief phase. The public is not here yet. The media is not here yet. This silence is your biggest advantage. You must also consider the wealth effect of a bond collapse. If confidence in government debt erodes, trillions of dollars of capital have to go somewhere. It cannot all go into stocks, which are already overvalued. It cannot all go into real estate, which is illiquid. It must flow into liquid, hard assets. Gold will take the lion's share of the institutional money, but silver is such a tiny market that even a fraction of that overflow will send it into the stratosphere. It is like trying to push the water from a swimming pool through a garden hose. The pressure will be explosive. So, what is the actionable move? It is to simplify. Stop trying to trade the daily noise. Stop trying to time the exact bottom to the penny. The strategy is to secure a position that allows you to sleep at night while the rest of the world wakes up to a nightmare. Owning physical silver, specifically in significant psychological units like a kilo, grounds you. It is a tangible hedge against a digital illusion. When the central banks inevitably pivot and flood the system with new currency to save the bond market, you won't be looking for a life raft. You will already be on the boat. The final thought is on the nature of regret. There are two types of pain in investing, the pain of discipline and the pain of regret. The pain of discipline is buying when it's boring, holding when it does nothing, and ignoring the mockery of the crowd. The pain of regret is watching the chart go vertical and realizing you saw it coming but did nothing. The bond market is creaking. The supply deficits are widening. The math is inevitable. The only variable left is your decision to act before the window closes.